this session. So first and foremost thing, what we are going to learn in today's session, we are going to learn semi-protected synthetic long future with convex crash hedge method. So this is a very long name and slightly complex also, but for the people those who are into the market or those who are into the option strategy, basically this is a very quality and useful learning. And as I few days before also I have released one video wherein I have told all of you, please use the AI tools for your study. So that doesn't mean that you should fully depend on the AI. You should have your own plans. So in fact, that will refine a lot of things. So if you are experienced enough, already learned a lot of strategies, you can refine that, you can modify your strategies, you can do many things with your AI tools, whatever is available in the market now. So you can say many things has changed and many things has uh, evolved in the market. So here we are going to learn one of the techniques called semi-protected synthetic long future with convex crosses. Before that, let me distinguish what is a option strategy and what is a option trade model. So many of you will be knowing the option strategy. Option strategy means it is iron condor, calendar spread, box spread. These are the option strategies, which is a combination of positions. You can say it is a call and put position. One call you are buying, next month call you are selling calendar. So like this way, or one put you are buying, next month put you are selling. That is also a calendar. So these are the strategies are only for the beginners. Those who are starting their journey, they should use these strategies. However, when you make it as a trade model, it is a complete trading framework that includes strategy selection, entry, adjustment, hedging, capital allocation, exit rule, everything will come into that. So then it becomes a model. Now coming to next part, which is the static and dynamic nature of this thing. First is the structure. Structure is option strategy is a plain structure. So most of the strategies are one-time entry, one-time exit. So that is known as your static strategies are static. Calendar or box spread, all these are the static strategies. Whereas a trade model, it's a continuous adjustments, and your Greeks you will be seeing that market condition wise you have to change that your views like this way. And third is focus area. What is your focus area in all this strategy as well as in the option trade model? So focus area is profit from price direction. Whenever you implement a strategy, you are telling either the trend is up, trend is down, or trend is consolidation. So your aim is from direction, volatility, time decay, like this way. However, whenever you focus on the trade model, you require consistent capital growth, risk control, probability management, sustainability, scalability. Means you can take in bigger quantity, you can sustain the things. Even though capital eroded, you can sustain and you can still recover back. So these are the focus area is different. Risk management wise, so you can say normal strategy, risk is predefined and option structure itself will be predefined, so there is not much scope. However, whenever you go for the model, position sizing, chain adjustment, hedge layering, volatility filtering, portfolio rebalancing, lot of things is coming into the risk management here. So third is professional application. Traders usually execute individual option strategy, retail traders. And whenever professional traders or institutional, they follow the option trade model. It's a combination of strategies. So you never know how the market is going to work in what way. So these are the differences of option strategy and a trade model. Now I'll be going to the subject. So here As I said to you, we are going for the option strategy. One example I have given here. So if you just see the example here, so strategy means, say we are buying BTC is 70,000. I'm forming a bull call spread. Means 70,000 call I am buying and 75,000 call I'm selling. So this is known as a strategy. So this is a strategy bull call spread. This is a name we have given, and this is a same expiry we have given. Outcome is limited profit, limited loss, no adjustment once trade is placed. So that is what will be there. You can find out its maximum loss, maximum profit. So because this is a option strategy, fixed structure, fixed risk, fixed reward, no active management. So these are the properties of your or properties of the strategy. So now coming to the next part, which is our model. How you can form a model, trade model. Similar one example I have given here. Same, say we have yeah, means BTC is at 70,000. One trader is selling that, thinking that he will sell 72,000 call option, have a protective 65,000 put options for cross hedge, and maintain a delta of a point 0.2 adjustment every 5% of business BTC movement. So this is called your BTC's BTC semi-protected yield model. So this is also a strategy, but you have many components in this. You are maintaining a delta. You are going to make one adjustment on each 5% move. So this you have different cases here. So your case one, BTC moves slowly upward, BTC crashes sharply, or BTC rallies aggressively. So for all these three case things, you have predefined logics, and that logic is defined, or that logic make it different. So here I'm just going to tell you, I have told you that what is a strategy and what is a model. So what is a option strategy and what is a option strategy model or yield model. So this is how we must think on the strategy front. So strategies are static in nature. It is a one time entry and one time exit, whereas you can say your trade models are complete framework. It is static, another is dynamic, one time trade, continuous adjustment, limited objective here, income hedge plus growth, simple payoff, adaptive risk engine. So these are the differences between the option strategy and option trade model. Now coming to that semi-protective synthetic long future with convex crash hedge. So every term involved here is having a meaning. What is a convex crash? That also I will tell you. Why it is called as a semi-protected also I will tell you. So these are the very, very critical part of the things. So why I like this strategy is, though it has a greater degree of risk, but when it offers the reward, it is you get a huge reward in this. You get a huge reward in this. So this is a strategy which you can say after a big fall you can initiate, or after a prolonged rally you can initiate, or if you are just in the rallying phase, if you are entering, then you can, when there is a big fall, you can initiate, means get good gains out of that. So these are the benefits of this strategy. However, so theta, little bit of theta engineering you have to do, little bit of complexities you have to add. So lot of things are there. So normally also many people do that. So many people do that without knowing that it is a uh, you can say synthetic long future. So what we are going to do here in the synthetic long future, basically, so synthetic long future means if BTC spot is at 70,000 and you have a 2 to 3 months perspective, it is not for 1 or 2 days. So 2 to 3 month perspective you want to uh, initiate this thing. So what you have to do, you buy a ATM call and sell a ATM put. This is your first step of initiating the things. So this is synthetic long future. But what happens here if the market fall afterwards? You can say your put also will be losing, your call will be losing. So both the cases you will be losing. So here it is only a name is a synthetic long future when you are double confident or 100% confident that is after initiating these things the price will never fall. So that kind of time many of the trader initiate this. But what happens here? Here the convexity is very loose. So you can say it is you are holding a future. However, only theta benefit will be there, but no other benefit will be there. And this will be at a delta 1. Why it is known as a synthetic long future? Future delta is always 1. So this process, whenever you are selling a ATM call, sorry, buying a ATM call and selling a ATM put, your delta also 1. If you take the reverse, delta is -1. That is also known as your synthetic short future. So this part of the things once you do, then you are saying that you are using a very lesser money as compared to the spot BTC. So if you are buying one BTC, spot BTC $70,000 you have to spend, but here with lesser. If you ATM call and put, if you are going for hardly some $10,000 you can own a BTC. But this also having this particular risk of initiating the strategy. You must tell me if that kind of risk is there, why people are taking this. So what happens? Somebody has a presumption or assumption that BTC has already fallen from 1 lakh to 70,000. So I'll initiate. So this is my benchmark. So from here it may not fall. Say he has initiated by bought a ATM call and sold a ATM put, and after that BTC has fallen to 60,000. So 1 month or third month contract he has taken, it has fallen to 60,000. So once that contract is going to expire, the trader what he does, he again reinitiate in the same strike because his aim is he will wait for 2 to 3 months. So same strike, same 70,000 call. Again he is buying though it is out of money, and that time 70,000 put will be deep in the money. So again he will have the same perspective, same initiation. So he's just maintaining the theta, he's not spending on theta, rather he's waiting for his turn. When there is a uptrend will resume after 2 or 3 months period, that time he will make a money. But here what happens, the trader who invest in this kind of strategy having a long term goal and thinking that the asset will never become zero. So if asset becomes zero, so what happens, the trader will lose heavily, but the 70,000 value of this entire think it will be lost. So only thing is that he is willing to lose the asset value goes to zero, willing to lose the complete thing. However, sometimes he is having a bullish view for the coming 2 3 months period, not for coming 2 3 days. But he do not want to pay the theta cost involved in the options. So for that, he is initiating this strategy. So it is a long-term plan, long-term view he has made. So how we will make it as a semi-protected? So we have a downside risk. So I have told you that if initiating this strategy, so after that, if there is a steep fall, so we will be having a bigger problem because the put will be losing and call will be also losing. So in that process, what happens? He has just the if you add one OTM put option, say 60K put option, do remember I am using the BTC as 70,000 as a spot. So this is deep OTM. So if he is buying one deep OTM put, along with this, what happens? It is semi protected, means its position is protected till, means unprotected till 60,000, but post 60,000 of strike the position is protected, but 70 to 60 there is a loss. So there is a 10,000 point loss is there. So till this point it is semi protected. So now coming to this, whenever uh, you are initiating some strategy, and many of will be analyzing with different tools. So you may be using some of the tools for analyzing this thing, graph chart, everything. So you will be getting one curve like this. So this is known as your convexity of the curve. If it is wider, its convexity is more. Means every small rise you are making profit, or after this phase of consolidations, every fall you are making gradual profit. So this is called your convexity of your strategy. Sometimes you will be getting some curve which will be in the V shape. So convexity means you are sitting here, immediate rise is exponentially giving you profit. Similar way, immediate fall also giving you a quick gain in the profit. So this is also sharp convexity or convexity of sharp in nature. So whenever if you want to study the convexity of the strategy, so by this process you can study. However, what happens, many of our predictive tools having one loophole, that they only predicts the, or the loophole of that particular tools are uh, they are theoretical in nature. On the day of expiry, what is going to happen, that they are going to put it. So here small changes if we can do it. So this is first part. I have told you what is a semi protect, what is a synthetic long future, what is the view in which the trader is taking that. Instead of buying the spot and spending the entire money in that, the trader is only buying a call option and selling a put option without theta exposure. Do remember, the trader who is initiating this having two views in his mind, two concrete views in the mind, that this asset is not going to be zero and correction phase, if it continues for more number of days, I will be continuing the same style, or whatever. If it is coming 60K also, after 2 months I will be again buying the 70,000 call, and again I will be selling the 70,000 put. So, but this process the trader has convinced with that. So, for that reason only the trader initiate this thing. Why it is named as synthetic long future? Because by this action you are making its delta as one. So, future delta also one. So, that's why we say it is a synthetic long future. So synthetic long future we say because of that. And how to make it semi protected, because this is unprotected. Though it has unlimited profit, however downside it is fully unlimited. So adding one OTM put option, it will just act as a disaster insurance, or in case of a huge fall, this can protect to some extent. So this is known as your disaster insurance, or this is known as your semi protected nature of your strategy. So now coming to the next part. So I have also told you what is the convexity in a strategy, the graph what you are seeing. So the nature of the graph will tell you the convexity of that particular strategy. So now we'll be going for the next part. So here, so option strategy and its difference I have told you. Now I'll be moving to the next part of the things. So here, your final structure will be like this. You will be buying a call, selling a put. Along with that, you should have a buying of a put. So this will be only for convexity crash situation. It can give you the profit. If you have any query, you can keep on asking in the question pen. So at the end of the session, I will be taking it. So now what happens here? So it is telling that what is a convexity crash. The so for this particular hedge will become more powerful. You can say whenever this hedge you have done 60K put, so till 60K, 68K, you can say small gain will be coming, 64 faster gain again. So the put will be going on adding that. So gains in case of a panic. However, it is still is a semi protected. So in case of a panic crash, it will have the great amount of protection. But we don't want that. So here still many part of the convexity is there. We want a flat convex nature, we want more protection, we want to make it, this is a model, we want to convert this model to a great or scalable model, so where we can stick into that, we can stand on that, we can have a bigger freedom to operate that strategies. So that things how we'll do, that is very important, that thing how we'll do. So here what I'm telling here, instead of, this is the final structure we got, this is the final structure we got, and this is with the, this particular part, left part, what you are seeing, it is a final structure we got, and this particular structure having a semi protection nature. To make it more sophisticated, close to a professional convexity risk engine model, so what I will be suggesting here, the 60,000 put what you are taking, so make it deep, again make it far out of money. So 60 will have a lot of theta into that, so I do not want to pay that much of theta. So rather what I am telling, go down by another 5,000 point, go for 55,000 put. However, you also, this particular call and put will be remaining same, but this is 71 deep ITM put also you can buy. So anyway, this is your this is your delta as 1. So you, by initiating one deep in the money put option and one out of money put option, you make this delta to 0. So initially you make the delta to 0. And do remember, these two strikes of your put option purchase, so along with this synthetic future, so synthetic future will remain as it is. These two options, what you are going to buy. So if your synthetic future is in the current month, I will suggest take these two things into the third month. So you are going to wait for 3 months. So expecting a big up move to happen, or expecting a big up move to happen in the future, so you can have a, this third month projections you can have. So if you see that now it is, we are at a nifties of 24k, approximately 24k. So if you have a aim that no, I want the nifty to be by December, it will be 28,000. Say 28,000 is your aim is there. So 24 to 28, there is 4,000 points are there. You want to involve yourself, and that too also you are aiming for December 2026, not now. December 2026. And so if you want to make a model, so what could be your this thing? So you can say one con, professional convex risk engine model you can form. So one deep in the money put options will be there. So your 24k is a standard. You can say that is your benchmark there. You can buy a call, sell a put. So exposed to the higher downside risk. However, you can have say either 24k put or 25k put, deep in the money put, and along with that one deep out of money put, say 22k, 21k put. So that you can have, and once there is a bounce back, you make very good money. So you must ask me, why this deep in the money put option? So that too also in the longer series. So longer series, what happens whenever you go with the deep in the money put option purchase, you will be having a very less theta to lose. However, you have lot of intrinsic value to be lost, in case of there is a, say if it is in this particular case, if it is going to 75k, so your intrinsic in the 75,000 put options will be lost heavily, lost heavily. However, it will be adding lot of theta here, and no doubt your 70,000 put also would have lost most of its theta. and 70 call option also would have added a great amount of intrinsic value and lost the theta. So 70 call and put, I am not worried about whatever theta loss one is happening, other is compensating, so that I am not worried about. However, this 75,000 put option will have a great amount of theta, remain with it. And since this is, you can say, if this is in the current month of May or June, so this particular will be in the July or August. So this particular combination will be in the August. So plenty of theta will be there. But if there is a great runway happens after 75, after 75,000, then you will be at a great profit, and you will be making a huge gain there. So question comes here. So what for this 55,000 is being taken, and why it is taken? So these two we are adding put long positions to make the delta as zero, just to see that we are neutral at the market. If there is a huge correction happens, if there is a huge correction happens after this 70k, you can say, if there is a correction happens to 55k, so if there is a correction happens to 55k, what will be my take here? So definitely the call will be worthless. The put would have added a great value. So what I will be doing here, I will be keeping 55,000 put as it is, and I will again bring down my synthetic futures to 55,000 strike. 55,000 strike. So if after I initiate the position, if there is again a deep correction happen, so I can move my synthetic future to the 55,000 level, and at that time 55,000 put would have been appreciated to a great extent, and my 75,000 put would have been taken care of this losses in the 70,000 put. So there is, in the second attempt, I don't require to hesitate twice with the put options. My 55 is already there. I'll just bring down my you can say synthetic futures to. So 55,000 strike I cannot have. I can have 50,000, 56,000, 57,000, or 60,000. I can bring it there, so that I will have a greater hold on the strategy. But here, one catch is there in this particular setup, which we say professional convex risk engine model. So in this professional convex risk engine model, imagine a case that there is a steep correction happened, and it is coming to 50k, 50k level. So steep correction happened, and it is a 50k level it has come. 50k level it has come. So what will be the what will be the implications here? So this call and put, directly you can bring it to 50k level. This you can book a profit. So your 55 put is there, your net will be definitely at a profit at this point of time. So there is no need of adding one more 75k put. Rather sit at a 55 50k level. You bring your synthetic future and stay there, and you will have a great reward in that. So this model of a professional convex risk engine model, you can utilize in different ways. Suppose somebody does not have a 3 months goal, somebody having a monthly goal, somebody has a monthly goal in that. So monthly goal in the sense, somebody is having that, no, my monthly goal is that Nifty may have 500 or 700 point of movement in 3 months time. So 3 months time, so wherever Nifty is standing or any stock is standing, that will be having a 300 points or 5% move up and down. So 5% move up or down it may happen. So what you can do, you can have a at the money call option and put options nature like this. If you are bearish, you can have a opposite, buy the put, sell a call. Or if you are a bullish view is there, some view you should have. So with that synthetic future long or future short you decide, then In these two put options, what you are going to make, you just make it something is only 5%. So your ATM strike plus 5%. So in the money, and ATM strike minus 5% out of money, these strikes you can choose. But I always suggest these two put, whatever you will be choosing, make it for a longer term expiry so that your theta decay will be slow. And in case you want to alter your view, if you are a synthetic future long and tomorrow after 15 days you are thinking that I'll become a synthetic future short, so what happens that time, your theta impact will be very less, so you can alter it. So this strikes you should take it in the longer expiry. So 3 months I had the line, 6 months I had the line. If you take this kind of, if this kind of view or this kind of put option, if you make a purchase, one deep OTM and one ITM you need to decide based on your own study and the technicality. So ITM, how much point ITM you require. So if you follow this, what happens, your this particular model become a good model to on every time frame. So this is how your synthetic protected long future with convex crash hedge method works. Objective, initially it should be delta plus 1 or minus 1 based on what kind of synthetic long future or synthetic short future you are initiating. So if you want to have a partial hedge or semi protected, so you add one put options and preferably OTM put option and bring that, reduce that delta. But here, if you want to make it as a risk engine model or professional model, you add two put option or two call option based on the synthetic future long or future short. So bring the delta to 0. So while choosing these put options, purchase, one should be in the money, one should be out of money, and this put option should be chosen in the, should not be in the same month expiry, they must be in the longer expiry to protect you from the theta decay. So this model is very important. And if you want, say, if you trade in two instruments, say you trade in BTC as well as you trade in the ETH, Ethereum. So you can have a ETH. You can have a synthetic long future in BTC or synthetic short future in ETH or vice versa. So this also you can have, and then after your models, so put options you have to, on call options you have to accommodate like that. So every movement you can get that money. Or if you are trading in the Nifty Bank Nifty, have a view of Nifty having a synthetic long future and Bank Nifty should be synthetic short future. So similar way with the stocks also you can have. So this is based on what kind of trade you are doing and how best you are putting into the action. So this is what he is asking. This is for the first month, and this is for the third month or fourth month or sixth month, anything. So what happens here? So first month it has gone wrong. So we have moved this thing to the second month. So whenever we moved it to second month, whether we can still continue with the third month or we should change it, I will suggest change it. Accept that losses and go to the new month. Keep your aim here is to protect your theta. If you stay in the third month, your theta will not be protected. So theta protection is your first aim. Delta 0, theta protections. So here theta will be negative. So initial setup, you will have the theta negative. Do not keep that theta as negative. So what happens? You move to the next month. Once you are moving your synthetic future to next month, you must move your delta normalizing factor to the next month also. So that time you decide what is the strike, where it has, if it is not moved anywhere, very close consolidation happens, so better I will suggest move it. So once consolidation prolonged for 10-15 days, then definitely some direction will come. So for that, you need to move to the next one, so that you should have greater freedom in that. So you can utilize these things in many different ways. Suppose it is a very high volatile market, so do not stick to this ITM OTM concepts if you are into a very high volatile market. If you are in a very high volatile market, so you know that volatility comes with the price correction or anything. So that time, instead of having a ATM and OTM, you should have multiple OTM also. OTM also, if it is, that is saving a cost, and that also having a great freedom. So instead of 75 55, I can have four lots of 55 put also, that can be there if it is cost effective. If it is cost effective and having that kind of volatility intact, so I can choose that also, because I will have a rapid expansion in the delta if I have multiple things there. So instead of two lots, I should have four lots there. So if you are thinking that, okay, I am currently sitting here, so why I should go for, so definitely the price is not going to sit in one place. So many models you can form. You can just have a look and take this thing as a prototype, but you can have many models. Say if you are forming it in the May or June. So, and you are thinking that price will not be sitting in the same place for the 2 months period. So, instead of going in this order, if you are going for, say, other month, you can say you are going to a month of, you can say July or August, you can have same 73 lots also, or two lots of 70 put also. If you think it is a good wild move is going to happen, you can have that also. So your views, whatever actions you take, you can, based on that, you should be rewarded. Or you can have in this order also, just have a 70 put and have a 55 put also, and as and when price moves. So if this is call is going to give you the success, so 70 you change it to 71, have a chain adjustment 72, as and when you are going on nurturing the profit in this. So keep on changing your put, second put, make it more dynamic, and by this process also you can harness more. So that is, you can have multiple thinkings onto that, you can add multiple thinkings into that. So same way also, I have released one video couple of days before, how you can utilize in your uh, AI tools. And I'll again request all of you, you must use the AI tools, because whatever the strategies I was teaching, giving, and other things I was doing. So now when I look back and use the AI, I found out that lots and lots of improvement is required. So AI should not be taken as a bad tool. You give your strategy and try that most intelligent, or your artificial intelligent brain, let it analyze that and give you what is bad in that, what is deficiency in that, what is wrong in that. So how to improvise it also, get some idea from that, try to improvise on that, so you will get lots and lots of improvement ideas into that, and you can add many things into that. So same strategy, this strategy, if you can just feed it, if you say that just look at trend and tell me whether it is right or wrong to choose these two put option of 75 and 55 or something else, it will also suggest you something. But stick to the strategy that I told you, the process how you should use the AI. So while using the AI, if you start accepting the AI suggestions, what will happen? This four leg strategy, he will make it to 12 legs. 12 legs. You add this, add that, and it will confuse you, and you will not end in any place. So while using the AI, you stick to your point that no, only four these legs are there, and you are only allowed to change these two strikes. Other than this 75 55, give me any other strike, I'll be happy. But I'll not increase it to a 8 leg, 10 leg, or like that. So similar kind of prompt you have to give there so that you can get a good answer. So, but that also again I will suggest, just take it as a information, just take it as a view, and then you build up your own things into that. So that is what Yogeshji's question was there. So I answered.